I'm Jason Healey, Senior Research Scholar here at SEPA, and we are here for the final, perhaps the awesomest, we will see, panel of the afternoon. Everyone go crazy, all right. So, you've got the bios of our awesome panelists, so I'm not going to go too much into their backgrounds, but I will a little bit, because we are here to talk today about the overlap of technology risk and cybersecurity, which is something we've touched on in all of the panels today. How that interacts with traditional financial stability and trying to think more deeply about these areas. And then we're going to layer in how does internet fragmentation, I was going to say fragmentation or plurality, but I don't see Ellie here, so I can get away with fragmentation. How does this affect financial stability in this technology risk equation? So we've got just a fantastic set of panelists to handle this. I'll go down the order that they're in the program. Siobhan MacDermott and I've only met her, and I'm just figuring out how fantastic she is. At Bank of America doing cybersecurity public policy. Paul Twomey, he is fantastic, and I've known him for years when he was the CEO of ICANN, and we've done ventures and all sorts of things together. One of my colleagues here at Columbia, Chris Cummings, had been the COO for the New York Fed. Fantastic, and I can't wait to get to know her better here at SEPA. And Kathryn Rosen, who I met when she was the Deputy Assistant Secretary of the Treasury, background in finance, and she was overseeing many different parts of Treasury, including the critical infrastructure protection as well as insurance and other areas. So we're really able to come at these questions from all of the relevant directions. So finance has been suffering cybersecurity problems for decades. One of the earlier panels talked about check fraud and how banks just had said, you know what, we're going to be suffering check fraud, but it's not that big a deal. We can take it, we can suck up losses. And it never became something that we were, you could watch Catch Me If You Can, the fantastic book and movie about what Frank Abagnale had been doing. And so even though this was happening, it never seemed to threaten the system as a whole. We've been having massive internet identity theft and credit card fraud over the last few years. And as bad as that's been, it doesn't seem to have been something that we have to worry about more systemically for the finance sector. The finance sector pretty well survived denial of service attacks from a foreign nation state. And we made through that with concerns, but not any systemic challenge. Well, what about as we're now starting to see internet fragmentation, as we're starting to see some of these deeper risks that we've been handling and hearing about in these other panels? We've held a few events on this here at SEPA. We had a dinner in January. We had an event more recently, just last month. We had the Treasury Office of Financial Research that recently published a paper on exactly this topic about cybersecurity and financial stability, risks and resilience, which I'd highly recommend if you're interested in this. And the Office of Financial Research called out 3 mechanisms where they saw cybersecurity could have an impact. So I'll read these 3, and then we'll start maybe with Chris and Kathryn that can lead us off here. Is they said, 1, the lack of substitutability in the finance sector itself. There are just some parts of the finance sector, well, all parts of the finance sector are dependent on IT. Some parts of the financial sector are absolutely systemically critical, and if they have a problem with IT, then we all have a problem with IT. 2, loss of confidence. You could have a kind of situation where the technology risk causes people to lose faith in the system itself. And we talked about a little bit that in trust in one of the previous panels. What happens when that's trust, not in, say, the electoral system, But what if it's faith in the banking system or a particular set of banks that, well, it might, for example, lead to runs? 3, loss of data integrity. What if we can't figure out who owns what? What if someone goes in and changes it? I think they did a very nice job in this paper. Chris, you've been focused on in financial stability for years. Maybe you can lead us off, and then we'll go to Kathryn next.
Sure, it's my pleasure. Thank you very much. Nice to be here this afternoon. So Jay did a great job of describing, in my view, what financial stability is. And that is that a bad thing happens and the financial system is able to continue functioning, might be limping a little bit, but functioning, making payments, making credit available, and allowing people to trade their securities. So in that world, what do we worry about? What could make that stop working? So the financial stability literature, a lot of which has been written since the financial crisis in 2008, talks about the mechanism by which we end up with a 2008 type situation where we have a deep, deep recession and we have a financial crisis at the same time, and as we all know, very difficult to get out of that. It starts with a large adverse shock. And that large adverse shock causes the net worth of people, like housing prices collapse, and all of a sudden you are poorer than you were before. It causes that drop in net worth. If we're living in a world in which people, financial institutions are highly leveraged, in which there are liquidity mismatches, that is, people are holding illiquid, long-dated assets, but they are funding very in the short-term money markets. In that kind of world, the financial system and to some extent the household sector or the corporate sector can end up amplifying that initial shock. And as the shock is amplified, the households, the financial institutions scramble to get more liquidity and to ease the capital hit that they're taking. And so they end up selling, they end up, financial institution, they stop lending, and that creates yet another hit to net worth. And you can see how this cycles through and becomes very deep. And what happened in 2008 is it happened in days, weeks, very short period of time, deepened really extraordinarily. So how do we end up thinking about cyber as one of those adverse shocks? And I would say that the challenge is really to translate a cyber event into dollars and cents in money that you can think about in this kind of model of financial instability. And unfortunately, we have a lot of examples out there, as you know, whether it's Target or Sony or others, so we understand much better what dollars and cents we need to measure. So as you know, the heart of most cyber events is a real disruption and interruption of service, and so you can start thinking about how long will that last, what kind of exposures will you have, and as a financial institution, you would worry a lot about credit, market risk exposures. The longer you're out of business or unable to act, the likelier it is that positions might move in a bad direction for you, and you will end up with losses. You also lose revenue during that period of interruption. And then there's the question really of destruction. What's not working anymore, and what's it going to take to recover? What are you going to have to spend there? And what kind of deeper fixes are you going to have to make? Think about destruction of data or corruption of data. That's going to cost a lot of money to fix unless you are already extremely well prepared. So this kind of framework of trying to put dollars and cents really requires a detailed knowledge of the various processes you care about, where when I was the COO of the New York Fed, FedWire was our #1 business. And FedWire, you care. How long is that out? It's going to hurt people a lot if it's not functioning. So in that world, you can start to really figure out how much damage is the cyber event going to do? And coming up with those numbers is helpful if you're a private sector participant, because it tells you both what needs to be protected, where's the worst damage going to happen, and also how much protection it's worth buying. You know how much you can lose if the cyber event occurs. But I think much more important for an audience like this is that, of course, the interruption at, say, a bank ends up being the interruption at the customers, might be interruption for the vendors, and so you have this contagion that occurs. And what you'd really like to do is sum up all of that damage. And that, I think, helps to build the case within the industry for collective action, the opportunity to do things together, pool resources, and get that protection. But it also, I think, builds the case for governmental intervention when that's necessary, that is government money, when that's necessary, because, of course, even the most minimalist of proponents of government action, that is, those who are really opposed to an intrusive government, would agree that security, whether it's national security or individual security, really a common good that is the job of government to help provide. So I hope that gives you a good start.
Can I push back on one or explore one there on the dollars and cents? Because I think I felt this collective shudder from the cybersecurity professionals, because if you try and put dollars and cents calculations on cybersecurity losses, it's one of the, I mean, you get 2 orders of magnitude, and we've literally been getting 2 orders of magnitude calculations since the Morris worm in 1988. So do you mean like that kind of precise accounting, or do you mean a more VAR, value at risk type model, or do you mean just kind of orders of magnitude to say, man, payment systems are like trillions and that's way more important than?
So I think that's a tough question to answer. We're talking estimates, of course, to start out with. So super precision, not possible. But I do think that there is a lot of work that's been done, for example, in understanding exposure and risk. If you are running a payment system, for example, there's an exposure there when you can't make payments. If you're running security settlement, another important financial activity that doesn't get a lot of attention and has that lack of substitutability you were talking about before, there's a place where you can measure what the risk is in there. How many days you're going to be out, for example, translates into X number of days times the amount of risk that is daily risk that's normally in those markets. And I think that thinking about that also gets you thinking about, what if this happens at a really bad time? Or what if this is so severe that it actually causes more volatility in the markets, more asset price declines, more loss of confidence in the economy, and start to figure out, maybe justify some of those huge range of estimates, that there's really a worst case scenario, and there are better cases that end up with less losses. I think revenues, I think the stress testing methodologies that the bank regulators have developed actually have a lot to recommend. They have to be rejiggered for this kind of work, but thinking about how much revenue would you lose in a tough situation is something now that banks have done a fair amount of. And so again, these are always estimates, but I think sizing the breadbox really helps in terms of understanding just how severe the problem could be, and again, trying to figure out how much resources to use to protect against it.
And this is one of the things that came out from the conversations that we've been having, is some of the scenarios and how is this different. And usually when you're in a financial crisis, in general, most of the market participants don't want a crash. They might want a strong market movement in one direction to their benefit, especially say in currency markets. But in general, the participants don't want a smash, and that's the kind of thing, when you think about the timing, you might have an adversary that says, this economy is having difficulty right now. With a bit of a push, I can make sure that this is going to be not just a crisis, but a recession. And that puts, I don't think that on the financial market side, you're necessarily thinking about such malicious activity from someone from the outside. Kathryn, so from your time in Treasury, I mean, and you're, having been a banker, I mean, you've been coming at this from both sides, and maybe you can start us off, continuing in the public policy, and then we'll go from there, and we'll hear from Siobhan more on the straight banking side.
Sure. How do I take this?
I think it will.
Great. So I'll just give two events that happened in the marketplace. In 2013, the NASDAQ stopped trading a certain band of tickers, letters P through Z, say, and we learned quickly that the Securities Information Processor had gone out. And sitting in my seat at the Treasury Department, I quickly got a call from the Secretary's office saying, is this a cyber event? First thought. And again, the NYSE had an outage in 2015. Very quickly, folks see the news on the screens, and very quickly the question is this a cyber event? And what could happen next? And really keying off of a lot of the language that Christine used and just thinking about the financial stability lexicon, we started to quickly use the same lexicon as we started to think about cyber risk. Whether that was systemic risk. Is there a systemic risk here in a cyber event? We obviously recovered from the NASDAQ SIP outage, and let me tell you what the SIP is actually. That's the system that takes trades and quotations and actually gives you real-time information on where the market's trading. If that's out, you don't know actually how stocks are trading. And so you start to have these conversations about a SIP outage, that node being very important. Where's the transmission channel for risk? Where is the contagion for risk? Will we be able to recover? Will we be able to resolve issues? And you can almost do a mapping of language between the financial stability community and how this cyber risk dialogue can evolve in the financial services sector. But the analysis is a bit different. We can talk about, and Chris alluded to, aggregation of risks in lending books, in credit, aggregations of risk in other parts of the market, these shocks that come on. And when you start to think about how do you look at transmission channels in cyberspace as it relates to financial services, you very quickly have to look at processes flows. How does the market actually operate? And we have an incredibly fragmented market, and we'll talk about internet fragmentation and how it fits in here. But the financial services market itself is incredibly fragmented. You really start to wonder what, I call it the subterranean view of the marketplace. What is the real plumbing? How does the plumbing actually work such that you could have some sort of cyber event? And when you start thinking about the plumbing, you really quickly have to get to understanding how all of the processes, how all of these pieces fit together. So a SIP outage actually becomes important because it's the communication device for the marketplace. So we embarked on a project at the Treasury Department where we started mapping the plumbing of the markets. And you learn quickly that there is no like plumbing. The equity market, the fixed income markets, the swaps markets, the futures markets, all trade with different market participants, different folks on both sides, the buy and the sell, and all of the flows in between, whether that's information, whether that's systems, whether that's where you plug in, all of this is different. And you find that there are many, many parts of market vulnerability. So you ask questions of where are we vulnerable, where do we lack substitutability, as spoken to before, and it becomes this grand, venture in architecture of the system to really try to figure out how do you protect this sector from this contagion. I know Siobhan has some experience in doing this on the institution basis, and a lot of the financial institutions on the whole have done this. But once you take those market participants, there's all these other bodies at work. So that's really where you can start thinking about this financial stability argument against the cyber risk. And we really have to understand the plumbing and the mapping of the system to really figure this out.
And it reminds me, as you were talking about that, it reminded me Eric Schmidt in his talk earlier today. He said when he was talking about the internet 10 years ago, you could still have manual workarounds. Is, really, you can't now for any significant function. I mean, you might for a few here and there, but in general, you just don't. And it's something that I think we can keep coming back to in the panel. We've got, are we now having these IT institutions that are too big to fail? These systemically important networking or IT institutions, and the concentration risk that now does the finance sector have this concentration risk in the IT sector, or and if so, then how might we think about that? Maybe you can pick up on and Siobhan, and because one of the reasons that we're really happy for you to be here, not just to talk about what's happening in your own institution, but the sector has really responded to this in the last year. I mean, certainly in response to signals from the government, but also a lot internally driven. And I'd really like for the audience to understand so much of that.
Sure, thanks. Thank you so much for having me. One of the things that we did in response to an executive order that designated several of the big banks as critical infrastructure is our CEO and the CEO of JP Morgan Chase got together and said, let's do something about this. If you guys are going to designate us as this, and we're going to bear that label of being critical infrastructure in the financial sector, what can we do to see and help and get everybody together? And they stood up in October of last year the Financial Systemic Analysis and Resiliency Center, otherwise known as FSARC. And FSARC started with the 8 founding members of that institution. It sits under the FSIS Act, and those are pretty much the 8 large banks in the United States. And what it's designed to do is look specifically at systemic risk and looking at, not if just one of us fails, but what happens if, say, 6 of us fail simultaneously on the basis of a cyber attack? What happens then? How do we get trapped liquidity out of the market? How do we continue to get people access to their money? Because in today's day and age with, all the social media, the minute a customer can't access their money, it's lit up all over. Chris mentioned a lot of the issues around the costs of not being able to process. There's a brand cost that's a huge, huge cost here. There's a loss of customer. There's a loss of confidence in your institution. And basically, a lot of this was designed to try and help avoid that. The FSARC also works with several government entities to improve information sharing and looking at how do we share information not only amongst ourselves, but with the government on both a classified and an unclassified level. And one of the things that we've seen, across most of the institutions is that the threat used to be predominantly around stealing money or the exfiltration of credit card data, or around organized crime. As that activity moves to nation states, that's when you start to get a look at something more systemic, much more sinister, much bigger, to the point of not only economic manipulation, but geopolitical manipulation. How do you crash a country? Fastest way to do that is to kill a financial sector. So there's both good news and bad news. The financial sector is pretty far ahead of other sectors when it comes to cyber. There's a reason for that. We're also the most, arguably some of the most attacked infrastructure. Jay, you talked a little bit about the technology companies and too big to fail. One of the things that the banks are is, incredibly complex, interconnected global systems. So a lot of the conversations that we have is say, hey, there's a risk going on over here in country X, Y, and Z. I'll pick on Germany. And, just like somebody would suggest to the utility company, well, you just shut the power out in that region. If we turn that one country off, it has shock effects throughout the entire system. It can create destabilization. It can create all kinds of issues. And what if, the top 3, 4 banks in the United States fail? Do you want your money really running through a nation state potentially, because that's the only other large institution globally that can handle that traffic? So these are all the big kind of questions that the FSARC was brought together to answer. And it gets increasingly difficult as these big, complex geopolitical players and nation states get active in that realm, because it's not just the notion of, a criminal organization attacking one institution. One of the things that really struck me when I came to B of A was I talked to my peers at other banks more than I talked to my team, because we're collaborating so much. We'll compete all day long on other things, but when it comes to making sure that the sector is resilient and whole and does not come apart, there's no limit to that amount of collaboration.
Oh, that's really fascinating. It's nice to hear in a day that we're talking, every other sentence has the word fragmentation. It's so nice to hear that this partnership is so built in these ties, and not enforced by the regulator. Encouraged, but that you're doing it because you depend on each other. And I think that's a concept, in the finance sector of counterparty, right? You're fiercely competing with these others, but you also, at the end of the day, need them to be there to accept your trades. And I think that, in In other places, you might call that a frenemy, but in the finance sector, right, it's built into the core of the system that you are critically dependent on your competitors, and they must be there for you at the end of the day. And we all saw what happened in 2008 when that doesn't happen. Paul, I'd love if you can kind of take where we've been on this. You've been here all day. You've gotten to hear all the talks. And the many different discussions on internet fragmentation, how that affects trust and trade and so many other issues. And I'd wonder if you can tie us in together with your background from ICANN and elsewhere.
Well, it does strike me that for 2,500, 3,000 years, the most thing that connected us was coins and money and that sort of stuff, right? And yet, in some respects, this is an outsider. The financial services sector, at least in my lifetime, has been a particularly isolated environment. Not in the sense of the way it interacts with the economy, but the way in which it interacts with other silos of policy or particularly policy and regulation. Central bankers sit in very comfortable rooms. They have these very quiet conversations. They say almost nothing over their cup of tea. And you have some interaction. I've been a regulator, I've been a government person, various things, and you very rarely hear from them. And it was just striking as you were speaking, that the world financial services sector actually has really real points of concentration, which make it, I think, quite vulnerable. You've got New York around parts of the functions. You've got Switzerland. You've got the bank. You've got the insurance stuff in London and Bermuda.
That's why we're in Charlotte.
You've got all these areas of concentration, and one of the things that worries me quite a lot, coming from the previous session, is if we inadvertently end up in real cyber warfare. If we do actually end up in nation-state conflict, we're going to end up in, and people do actually use logic bombs inside the electricity grids, and this actually happens, right? We'll be back at the end of the Bronze Age in ways that we've not thought about. Because I don't know that the financial services sector, the banking sector, can last 3 months, 5 months without electricity. And none of us have gold in our back pockets anymore. It's not the end of the 30 Years' War. I can't go and sort of dig up the pile from the garden and say I've got my cash. It's all electronic now. And so the thing that strikes me is the need for the financial, when we talk about fragmentation, and to some degree the financial services sector is the sector that needs to most be pushing around, we're all connected here and we need to interact. I think to a degree it's a sector that most needs to be, and I know this happens in some countries, but it doesn't happen in every country, that there needs to be this engagement about we need to be limited on things as extreme as warfare, and then I come back to things as prosaic as the way in which the ISPs work, which is a particular topic of mine. Just to give you some data, on the ISPs, there's four aspects of the ways in which people deploy kit badly, if you're an ISP, that actually pollute the system. OpenDNS, recursive servers, there's a bunch of these things which are pretty technical, but they are the product of somebody saying, okay, I need to deploy a whole lot of cable modems to a building, and let's do it quickly, and we don't reset the default password, therefore they've all got default passwords, and etc. An institute that I'm involved in, Cyber Green, did a complete analysis and says that at the moment, across the global network, there's about 5 terabytes per second of capacity available for botnets because of what ISPs are doing. And it's a market failure. Right, it's a straight market failure. The ISP has no economic incentive to actually do it well. And their cost to them is less, it just pollutes everybody else. Now it's 5 times the largest, it's 5 times the Mirai bot attack on DNS that presently is out there. The financial services sector, in my view, is the sector that is most vulnerable to damage from that market failure, because it's the sector that gets attacked often, is where the money is. And I use it just as an illustration to say, the Internet of Things is another one I'll come back to. The financial services sector strikes me is very flexible when it's selling to the rest of the economy, but when it actually thinks about the interconnectivity of the issues in the rest of the economy with its own stability, it seems to me less so. I'm really taking on the lions here, but that's one of the things that strikes me. When I think about the discussion around fragmentation, the irony is that this stuff all being connected has meant for the financial service sector it's the exact opposite. Even if the countries get fragmented, the financial services sector is the one which is actually increasingly building risk off every aspect of this, taking on risk off every aspect of this.
And as you're talking about that, it reminded me of something that came up in one of the earlier panels. It might have been Angela McKay that, when the software vendors were getting the signal from the customers that, hey, this is not secure, right? I mean, especially Microsoft, they stood up, the Bill Gates memo and that response, and finance sector was at the forefront of that. But that was very focused. This was your product. We're not happy with this product. Here you're talking about something that is all of the ISPs around the world, and an ISP that's poorly set up somewhere else could pose a systemic risk to the finance sector, and that's a very different kind of problem.
Well, and sorry, just if I can give another example of a potential opportunity. Some of you have heard me say this before. If I look at the Internet of Things issue and the supply chain of the Internet of Things, the vast amount of that is components that are built in East Asia. Those components will be built by companies, in my guess, run by 100 families. So it's not a 50 billion device problem. It's 100 heads of family problem if one knows how businesses work in East Asia. And those 100 heads of family would be mortified to know that the family reputation was at risk because of work they were doing in the plant in Malaysia or in Eastern China or whatever. Now, who knows the heads of families? Banks, right? And so to some degree, there's points of leverage for discussions that you just have a conversation. The senior person at the bank says, look, just don't want us to be attacked by stuff you haven't done well. Just want to say it to you quietly. And in that part of the world, quiet conversations really matter. So there's creativity issues, questions here, strikes me, about how to respond to those risk issues.
That's what I found, and I'll ask one or two other, one of the things that struck us about 2007, 2008 was when the finance sector started to have their problems, there were mechanisms in place, right? You could go, there were central bank governors in every country. There was the IMF, there was the Bank for International Settlements, there were so many others, and when those weren't enough, for example, the G8, they were still the foundation that you could say, all right, we're going to put the G20 on top of this. And I said, all right, well, if we had this issue where this technology problem affected you and all the rest of us, it bothered me that the IT sector doesn't seem to have the same kind of response mechanism layered on top like finance does. Right? I mean, if you had to get together, the head of Microsoft and Google and Apple and AT&T and Cisco and Deutsche Telekom and PCCW, I don't see that we've got that same kind of response mechanism.
So I'll say this much, after the beginning of the FSARC, there has been a lot of conversation about sort of cross-sector collaboration, looking at the critical infrastructure, so we would say power and utilities, telco, financial services, and all of the things that we depend on. There's a lot of discussion moving in that direction. The challenge you face is that we are, to your point, globally interconnected. There's only so much we can do. The U.S. government can help us, obviously, within the walls of the United States, but the minute you cross over into another country, you lose your leverage completely. Or people just don't want to play ball, or you've got to figure out how to switch suppliers. I think one of the things, certainly from my perspective, if we've made phone calls to those folks, they've come to the table pretty quickly because they don't want to lose us as a customer either, right? There is a little bit of give and take there. And I think that they are, the technology companies, we get asked if they represent a large amount of risk to us. Our systems are so complicated, which in and of itself presents its own form of deterrence because they're just difficult to understand, right? You talked about the notion of all these different systems for payments, different systems for this, different systems for that. That adds complexity. Complexity also diversifies your risk to a certain extent, where you may only have, a vendor exposure that's limited over here. And by the way, every bank does this differently. So no two banks have the exact same systems running in the exact same places and the exact same, operating mechanisms underneath it. So it does layer on some limited, difficulty if somebody wants to go after you, but your point is valid about going outside of the U.S. That's where it gets really complicated really quickly.
I'll make one relatively cynical comment, and that is a cyber event could be thought of as a shock, and this just becomes another financial services sector resolution issue, meaning that depending on how much time we have to actually fix the problem, the technology questions are going to end up being talked about here, while the rest of the community is talking here. So the regulatory community, the Federal Reserve, all the actions that they will take will probably be marshaled in real time very quickly, we hope. But the technology question, how do you fight the technology battle while you're having to stem the tide of all these other kind of traditional financial run questions and issues you may have?
And one of the things that occurred to me when Siobhan was talking is we learned after 2008 that, what was the phrase? Banks live globally but die nationally, right? I mean, these banks are big global banks, but when it came down to it, they had one headquarters in one country, and the interests of those countries on that bank's assets, and how it died, and who was going to get their slice of that. I mean, it was a significant issue from my understanding, and I'm curious what that means for the internet and a fragmented internet, right? If the internet lives globally, I mean, how does it die, especially as we start doing regulation? And I don't know, I'll just kind of throw that out there and see if anyone has something maybe on the first side of that, on the banks. And maybe
from the regulatory
Siobhan
standpoint,
and then
we have over 200 frameworks we have to comply with globally just in cybersecurity, and about 50% of them are in direct conflict with one another. So, if you comply over here in your home headquartered state location, you're in violation of 50% of where you sit. And these things make it increasingly complex. So you have trade-offs, and you make decisions, and you take risks in certain places. But that notion of getting to a common framework is incredibly difficult, again, because it goes to the lack of sophistication of some of the infrastructure, quite frankly, in some of the countries we operate in.
I was going to say that there's still, I think, an inability to fully conceive of what a real bank is today. And that is, it is a set of networks. You operate through those networks.
They're tech firms.
And there just aren't, they are tech firms in the extreme. There really isn't the kind of collaboration that there needs to be between the kind of people who do analysis of banks and the kind of people who do analysis of these physical networks. Because what we're really talking about, and again, that goes back to Kathryn's mapping exercise, is the interaction of those things together. And so I would really encourage more research that involves people both from the technology side as well as economists and analysts of various sorts.
And more well-funded research, wink, wink. And sort of on that point, when I'm talking with bank executives, I say, look, this is your investment technology, your information technology is the longest bet you've ever made. Like, this is the longest position in financial terms, right? This is you buying a whole lot of something that's put your entire franchise at risk. And your hedge is some spending on information security, some spending on business continuity, some spending on crisis management, some spending on resilience. You would never take this kind of position in any other place. You would say this is too risky with this little head. But this is exactly what almost every bank has done, is take this incredibly risky position that puts the entire franchise at risk. I'll do one more question, then we'll start, we'll go to the audience here. FinTech. I'm really curious, as we start looking at these new financial technologies that are coming out, right? We heard from PayPal today, we had Alibaba, all sorts of new ways to do consumer lending, small and medium-sized enterprise lending, self-funding, alternate payment mechanisms. Can we say overall if these are going to have a stabilizing impact? Are they going to have a destabilizing impact? It is just too early to tell, or it's just too complex.
I'll throw out one general comment, and it's just in terms of how do you get to these entities from a rules of the road. I think it was mentioned in the last panel. this self-regulatory mechanism, or how do you have folks actually come in line with the governance? The only way to get to these entities right now is, from a regulatory standpoint, is through third-party regulation. So you actually have the financial institution that's plugging into the FinTech platform, reaching to them to say, we need you to have the following governance in terms of cybersecurity and cyber hygiene. So I'll defer to those in actually Siobhan, who's working with these companies, but it's a very interesting question on how do you make sure that they actually have the hygiene to participate in this marketplace when it is as interconnected as it is.
I would say, we treat them like third parties, and we work with them very closely, because obviously we want to be able to invest in those kinds of companies, we want to help grow them, we want to be part of that evolution. It is a very nascent industry. In some cases, there are very small companies that aren't necessarily thinking, to your point about cyber, as even part of the equation just yet. And in some cases, they're big players. And those big players, we may already have an established third-party relationship with. At that point, it becomes a lot easier to be able to interact with them. But when you're talking about the young startup firms, the challenge is obviously to ensure that they have exactly the same kind of requirements that any third or fourth party we work with would have. And they have to comply with that in order to be able to plug into our network. And I think that's universal across all the banks.
And my sense is that most of these fintech firms really need the current plumbing to be able to operate. They need access to people's accounts. They need to be able to send payments through the ordinary system that we have today. Again, I think it stresses the work that Kathryn has been involved in, how important it is to really understand that, and also what the barrier to entry is. If you want to create a whole new payment system that doesn't touch the clearinghouse or the Federal Reserve here in the U.S., that is a pretty heavy lift in terms of connecting with all the points that you want to be able to make payments with.
You talked about the question of fragmentation. I do think fintech is a force of fragmentation, but probably not in a way in which it's popularly seen in the United States. It was interesting to watch in the last 5 years. I spent a lot of time in China. Watched the government come out with a set of policies around its internet regime. And one of the things it particularly promoted was the use of internet in financial services. Now, as a dumb outsider, part of my interpretation of this was a way of getting around heavily entrenched, large, politically bureaucratically powerful banks, and get new forms of financial services and what have you out into, especially away from the big cities, etc., etc. And so, central government using fintech as a policy is potentially a form of fragmentation. I mean, in some countries you may well see that it'll be pushed as a way of actually breaking up the existing cartels or whatever. So.
Yeah, and I'm not sure if I necessarily feel better that the fintechs need the existing, for example, payment systems, because just like we were seeing when, for example, I guess video started being covered on networks, right? They just weren't really covered for streaming, and it's taken the networks a long time to deal with this wave of bandwidth that hit them, and it just now we've expanded the number of places from where a shock might, from that spark might hit the dry grass. So there are reasons for us to make that feel better and maybe not so much better.
Well, to the point where you're mapping, right? So you've got all these points and you figured out all this interconnectivity, and now you just have a whole other set of layers of interconnectivity you've just added that creates more weakness in the system.
Great. Okay, so I've actually got lots more questions, but we really want to hear the ones that you have. So if you want to come up to the microphone, and right over there. And the sound folks did let us know that the Microsoft cuts off if you speak more than 15 seconds. So I would just keep that in mind. So please make your way up. In the meantime, the payment systems. So when I led off with this, I talked about credit card fraud and these other issues that have been that have hit banks over time. And the one I didn't mention was Bangladesh. and SWIFT. And maybe someone can, and I know FSARC has been looking at payment systems, and I don't know who's been maybe paying the most attention to SWIFT and the Bangladesh incident.
I'm all for taking questions from the audience.
I haven't seen any. I don't think they are. So at least from what we've been reading from the news, it looks like maybe a nation state had gotten in to SWIFT. Am I missing cues?
Sorry,
important social
no.
cues here? No.
No.
And did not compromise SWIFT, but was able to compromise one of the banks using SWIFT and was able to steal a fair amount of money from that. And when we start looking at, when we've had these conversations, two of the things that most came up again was keeping the public trust so we don't have a run on banks and payment systems. When we start thinking about what's really kind of core and critical in this. And so I was really happy to hear payment systems come up a couple of times here. Is there anything else that we might add to that, to some color and how we're thinking about payment systems and how we might further protect them, because they are the plumbing that I don't think people understand exactly how important the payment systems are.
Yeah, so you mentioned the FSARC is taking this on. They are. It is a work stream looking at the wholesale payments process, and we're looking at it from the context of both a cyber attack and a non-cyber attack. The non-cyber attack being, somebody just did something dumb somewhere and stuff shuts down and we've got to turn it off, pull the circuit breaker. And then how do you determine when a bank that is stricken can come back online and become, get back into the system as a trading partner? And then there's the cyber attack version, which is the doomsday scenario that everybody goes out. And so we've got 6 banks down. How do we then continue to move money and move it around the world, and where would we likely fail over to, if you would? So which global financial institutions could pick up some of that slack if the U.S. financial institutions came down? So that's what we're looking at, and that's the initial project. There's 15 other systems just like payment systems that are probably equivalently critical that could be under the same kind of auspices. But there's also the notion of at what point does somebody call a bank holiday and say we've just got to shut everything down because it's so bad, or if it's a cyber attack from a nation state that's going to cause the system to be down for multiple days, and how do you recover from that? These are all the kinds of scenarios we're thinking through. We're testing. We've got government partners involved. We've got the banks involved. We actually have additional non-FSARC members involved in this. So to your point about the clearinghouses and other folks that are in the loop around wholesale payments, and we're creating the scenario, stress testing it, and doing a tabletop exercise against that, and learning from that.
So much of the conversation has been U.S.-ish, and
Yeah.
mostly U.S. here. But your global responsibilities, you largely have been talking.
Yeah, so one of the other things is, as we've built out FSARC, we've seen a lot of international interest in that type of an event. So in the UK, they're building something similar. In Singapore, in the EU, we're starting to see interest from Japan. And the idea is being that they want to set up something similar to FSARC for their critical infrastructure, financial services sectors, and then find a way to plug in. So how can, if the Bank of England, the regulator there, sets up an FSARC with the major banks over there, how can they plug back into the US FSARC? How can we share information? That's when it gets very messy very quickly, because obviously with our close allies, that's a whole lot easier than with others, right? So how do you maintain that connectivity and contact? So we are starting to look at those big international problems, and that goes again to the point of the mapping that you were talking about that Treasury's done. How do we help broaden that across the entire system and do effectively a global map, right? And hide that in a vault somewhere, because if anybody ever got it, then that's how you take the system down. But that's effectively, that's what you need to figure out, because until you have these international points connected, there's still a single point of failure by a foreign bank or a foreign entity that comes onto the system and crashes it.
And we'll go to Kathryn here in a second, but I bet if you look at those maps, you don't see a lot of border. I mean, you can see concentrations that are particular cities of financial markets. And it's interesting you said that country, this other country is thinking of that their own FSR. It's going to be the same banks, right? We're only talking about 30 of the same banks in general globally. And so it's interesting that because of the natural border, because of the financial fragmentation, of a national regulator, that we're having these separate organizations that are really talking about the same things with the same maps, the same functions.
And maybe one local bank as opposed to all the other international big banks.
Right.
I was just going to add that I think the public-private partnership element here cannot be overemphasized in the sense that this notion of mapping and this notion of where are the boundaries of the map, you mentioned, where are the boundaries of the map, and there has been work done with the Bank of England and UK government in terms of stress testing in cyber, in terms of scenario analysis, in terms of gaming. All of these exercises that folks are doing in the financial services industry and with the government are, I think, imperative. The other thing is funding. I would love to see, Kathryn Rosen's great dream is to have a fund that's funded mostly by the government, but in part by the industry, that comes together and creates this great map. Payment systems, each of our individual marketplaces, of course in a vault, but really for the benefit of the industry to be able to protect itself. Because the interconnectivity is so vast in the financial services sector, we alluded to it, it's not only institution by institution that's interconnected, but the interdependencies across sectors is, I think, unique. You've alluded to it, Paul. I mean, you have the ISPs, you have energy, transportation. I mean, we learned in the physical crises like Hurricane Sandy that if you can't get money in ATM machines, folks can't get their money out of their ATM machines. I mean, things just as retail as that, as day-to-day commerce, because if the energy's gone, we're not doing credit cards, and if you can't get your cash out of the ATM machine because the transportation system is down, we have a breakdown right there, and that's a civil society breakdown, very quickly.
And Paul, Chris, and again, if folks have questions, please start making your way towards the mics. Right, it's up here in the front. The question, Chris and Paul, one of the things that really strikes me is that we've got a lot of critical infrastructures. Only 2 are really global, are really interconnected. And that's the internet and finance, right? I mean, yeah, you could say transportation because, the ships sail, but not in the same way that you can have the cascading failures that you had talked about. So I'm really curious if you two can start us off. Are there any lessons that you see from finance, from lessons of how finance is dealt with this that we might take on as we're looking at internet fragmentation and resilience, or vice versa? And then we'll go to Aaron.
So I think we're both in the business of real time, and probably ever more real time, and that's probably the big difference between a global supply chain and the financial sector, or, just the basic internet structure. I think that when you look over the kind of long stretch of history, look at where we are on resilience in general. And, that's been the accumulation of a lot of, years of lessons, a lot of bad things that happened, including the Superstorm Sandy, which I think taught us a lot more about civil society has to function in order to be able to keep the money moving. Those kind of lessons are much more generally applicable. And second, they really don't differ a lot from country to country. So if there is a FSARC in the UK or in Germany or in Europe in general, the learning that goes on here and the learning that goes on there, I think really builds a template for how you want to handle problems, cyber problems. And so again, the stress really needs to be on thinking through the bad scenarios, working through them, figuring out what really could go wrong, what's the worst case scenario, what's a better case scenario. I think there's a lot. I'm very sympathetic with Kathryn's point, which is we do need some governmental support in order to spend the kind of resources that are necessary to really dig into this.
Paul, any additional color?
Well, the thing that struck me about there seems to be, from what people have said, there's some similarities between the two systems. One is around this issue of security through biological diversity. Well, diversity that happens, you then later say it was biological, right? Because makes you sound smarter. The root server operators run different systems, owned by different people, different financial systems, and have withstood a lot of attack. We're losing that in the internet as the larger we scale down at the ISP, which brings me to my point about that we're having a scaling problem around some market failures about deployment things, because that's when it starts becoming vanilla. Now I'm going to deploy the same vanilla thing to 300,000 people who are getting a fiber connection, and now I have a problem. The other observation I would make, and I'm wondering whether this is true also in the financial services sector, it's a personal observation. I left ICANN, formed a cybersecurity consulting firm, went into a lot of cybersecurity consulting, and the thing that struck me and went inside the Fortune 1000 was that they're all the same. When the dynamic inside the company was cost and benefit at the board level, so give me the benefit of networks and technology and connection, but give it to me at cost, and there was no discussion of risk. The risk has only been recent. The result, as my experience, was that every damn network looked the same. And the only difference between them was how much merger and acquisition activity there'd been in the history of the company. No wonder people who are attacking it find it so simple. You learn one company, you can basically learn the next 50. And I'm wondering whether the banks are not the same. You said there's a lot of complexity, but I'm wondering, is there a similar sort of...
Yeah, well, I mean, I'm a recovering consultant as well, and I spent 18 months going into boards of about 150 Fortune 500 companies, and to your point, when the discussion becomes about risk and the diversification of risk and cyber in the context of business risk, it changes. When a company's been attacked, their posture changes, right? So when the CEO and the board are involved in a cyber attack, they start looking at what can we do differently that would have prevented that, as opposed to, to your point of deploying vanilla network solutions. And I think financial services has been on the front end of being attacked, probably harder and longer than some other industries. So there's more resilience built into that just by fact. I mean, look, we have America in our title. Half the world thinks we're the national bank of the United States, right? So when they get mad at America, they try and come after us. So you kind of become sort of the canary in the coal mine to a certain extent, which requires you to constantly be thinking about how you evolve. If you look at the big banks, I mean, look at how much spending we've done on cyber. Look at what our CEOs have said publicly on cyber. I mean, it's very different than if you're in pharmaceuticals today, where it's sort of just getting elevated to the board level now.
How much do you spend on cybersecurity?
Can't tell you.
Hi. So riffing off the idea of in a hurricane situation where you can't get money out of the ATM, it made me think of mobile banking and the rise of mobile banking in majorly in the developing world, for example, M-Pesa in Kenya. And what are the vulnerabilities of that system? And the second question is, in the same breath, is how has it, or what kind of management structures have there been where companies like Safaricom, which are cellular companies, are getting into the banking industries?
Okay, and can you say who you are and where you're from?
Aaron Stanley with Carnegie Corporation of New York.
And our thanks to Carnegie Corporation.
So I can tackle mobile banking. Look, we've got customers all over the world who want to travel to nation states and have access on their app to be able to make, multi-million-dollar transactions on their phones, right? Which represents a whole host of interesting challenges. So, you get to the point of application development, making that as secure as it can be, also educating your customers. We spend an inordinate amount of time educating them and telling them, where it's safe to do that and where it's not. Now, if they happen to live there, then, that might be a better option. To your point of, in an emergency situation, you do see that traffic level increase on the mobile side and go down because you can't access your ATM. But if the power's out, you're likely going to have your mobile networks out as well.
And mobile's one thing. The other thing that I see is the same thing happening across basic ISP services, peer-to-peer services. Again, there's been a lot of experimentation in China in the last 5-6 years. And in China, there's been a lot of up and down because of change of government fiat, but there's also just been performance issues and lots of very robust competition, might be a nice way of putting it. In sub-Saharan Africa, I expect you're going to see similar sorts of challenges about business challenge. And so, as you were talking, I was also thinking that it almost comes down to foreign investment review processes as well. You would review who sets up a bank in your country probably differently to who sets up a telco. You know, who comes in and sets up a mobile operator? And the history in sub-Saharan Africa, of course, is people did not invest in single countries, right? If I was investing in mobile operations, I invested across a series of countries to minimise my sovereign risk. That's very interesting. Once I've done that as a mobile operator, then suddenly it's a very different sort of bank. Now it's a cross-border bank almost immediately, cross-border retail bank immediately. So it's a really good set of questions, and I'm not sure it's that well explored
You can
outside.
imagine it being the final nail in the coffin for cash, right? If we have one of these situations where access to cash is the main issue, you can imagine PayPal's and other online payment systems, you know, Bitcoins and other methods of payment really taking off, especially if you can still clear and settle in the back end and you can still get your mobiles to work.
That's key.
So big,
If
important.
they have access.
Hi, Luke McNamara, FireEye. I want to go back to kind of the beginning of this question, looking at nation-state threats in particular to the financial sector. And it was discussed how targeting the financial sector is a great way to affect an economy. But kind of flipping this idea of fragmentation on its head, do you see any benefit in the globalization of the financial sector to where, except for maybe a couple particular nation states, everyone's integrated in the global economy, so there's a potential blowback risk for sovereign wealth funds or big institutional investors who are invested in the U.S. or other economies. Is there any sort of protection that comes from that?
Well, I think from the standpoint of, you know, as you get more of these sort of entities combined and you get the sector as a whole across borders working together, you do minimize a certain element of risk, because those conversations aren't happening today. Countries are still operating, you know, pretty individually. And as you get more countries together to like an FSR type of model where you've got information sharing and you're sharing indicators of compromise, you're sharing all of these stuff that isn't necessarily being shared today, it does provide a certain element of stability for the sector, because you can start seeing, you know, how these nation-state threat actors evolve or move across different geographies, because we certainly see that too. They'll start here, and when that gets too hard, they keep going, or they'll start going from the banks down into their third parties and find the weakest link in the system. So, yeah, I'm not sure if that answers the other part of your question. But.
Yes, it did. Luke, yes,
Sorry.
please.
I am aware of conversations at central bank level in smaller countries which are getting increasingly alarmed about what they call the weaponization of the financial services sector. Their primary hate figure is the Attorney General of New York, followed by the US Treasury, and that is the process of using sanctions in New York against banks, which cascades throughout the system. Those discussions are not in West Africa, but to give you West African examples, West African banks not being able to find counterparties for commercial transactions because European banks won't touch the counterparties because they don't want to lose their license in New York and they can't guarantee know your customer issues. In those discussions about that risk, the question starts to raise, will there be a nation state or other major actor who will decide that the asymmetry capability is just too sweet to ignore, and decide that if you're going to weaponize everything, the United States, then you've weaponized everything, and I'm going to now decide it's quite valid to launch major attack against your financial services sector.
This was one reason why I was
It's a real conversation going on
This
amongst
also
some central
ties
banks.
into the norms discussion about, you know,
Yep.
there's discussion going on at the G20 level about norms, cyber norms against financial service, or with financial services in peacetime and in wartime, and the agreement to not attack each other, right, across at least those countries, which gets you to that point again of getting collaboration across those countries.
Tim Moore with Carnegie and Dartmouth's done great work on that. And it was one of the reasons that I was such a fan of the U.S. cutting loose, removing the last, because I just had a nightmare scenario, and I know it wasn't very likely that Congress would wake up someday and say, why is a U.S. a company or an organization ICANN that is tied to the U.S. Department of Commerce allowing network traffic to travel to Iran and North Korea because they've got country codes, so let's take them out of the route. To some congressmen, I can imagine that making sense, and I'm still afraid that might make sense. Luke, where did you go to school? Columbia SEPA. If you're a Columbia SEPA student in the room or recent, please raise your hand. Fantastic students. They're learning digital in all of the stuff that they do. They're learning computer security. They can write. They can think. Hands up again one more time. If you haven't talked to them yet, please go talk to them. Better yet, go ahead and hire them. Okay, Melody, final question.
So, Melody Chen from the World Economic Forum. My question is, as you discuss some of these fintech phenomenon, and as we've seen the statistic that fintech has grown exponentially, I think the statistic is from 2010 to 16, there's more than $4 billion. And they obviously they have some of the things you mentioned about P2P lending, wire transfer, crowdfunding, and I was wondering, with these growth, some of them are contributed to the regulatory, lack of regulatory framework, and across the different geographical region. What are your views considering the financial market? How this is going to evolve, and how should, thinking the big picture, who are the stakeholders they should think further through, and what are the action that they should take upon, maybe for further action?
Yep, and maybe Chris or Kathryn, if you have
I'll say something. Some of the use of fintech is really to fill gaps that exist in our legacy payment systems and in other systems, credit card system, et cetera, and customers who aren't well served by what is available there. And I think the banking industry is working together on, real-time retail payments, for example, that would fit some of the P2P type needs that are not met by today's system, or are sort of met with in a complicated way by some of the individual banks. So that's where I would start. I think there's a lot of change. The problem with legacy systems is that they are difficult, and expensive to change, and yet I think there's a real consensus in the U.S. that those things need to be changed, and we need to make payments more convenient for people. There may be other things, like being totally anonymous and nobody can trace what you're doing, that are not going to be well served by the systems that we have today. But I'd sort of ask, why do you feel that way? Why do you want to do that?
Yeah, I was in Toronto last week, and I was just fascinated to hear the conversations that the central bank was looking at the CAD coin, or CAD chain, a distributed ledger coin tied to the Canadian dollar and issued by the central bank, and it's just fascinating to hear these new things that are coming out. Any closing comments, and maybe Kathryn, any final thoughts?
You can't leave Daniel hanging.
Oh yeah, okay. For Daniel.
Thank you. Daniel Schnock, also at SEPA. Just a quick question. Last week, Wednesday, for 7 minutes, major traffic to Visa, MasterCard, and other networks was rerouted through a Russian telecommunications provider as an accident, supposedly. How do you deal with actors on a regulatory and interbanking level? We heard that inside the US it works, but what are you doing when you talk with other banks, with other people in other countries? How do you address that? Do you trust them? How do you deal with trust issues between banks in different states that might have different levels or different intentions on this one?
That's a great question, and it comes back down to sometimes it's easier than other times. We were dealing with the Europeans really well until shadow brokers got released, and then they got suspicious of us again. So it does, to the extent that we've been operating in those countries for a long time with people on the ground who are working with those folks, there is a lot of trust built up inside of those specific countries. I think where it gets harder is when you have these geopolitical events that create a rift, or something happens in something that's in a country that might be a fringe country or a sort of a fringe nation state, then that trust might not be quite there. Geopolitical events play very heavily into this. If we have a government in the United States that starts talking about sanctions against a specific country, that country and all their allies become a little bristly when you were trying to do the right thing for the sector, because they're worried about us potentially slapping sanctions on them, and that becomes a difficult conversation. One of the things that, you guys study international policy, and it's so fascinating to me because that is the differentiator, and it's just a plug for students in this area. The differentiator today, because if you have that skill set, it's a huge, huge benefit, because most folks, specifically in our work, don't think about things from that context. And being able to put those dots together gets you to be able to be predictive about where you might encounter that next challenge with your next country you've got to manage.
And Paul, because this is, if I remember right, this is a BGP failure or attack. I wonder if you could maybe...
Yeah, well, then that's back to what I'm saying. There's a series of market failures sitting inside MSPs, and who bears the burden of it? I think the sector that bears the largest burden of the market failures around operations of ISPs is the financial services sector and its customers. And I would expect a pretty sharp conversation with somebody about the deployment of BGPsec or whatever it was necessary, if they were using the open IP network. So, but I'm still stunned how those conversations don't take place.
Great. Final comments as we dance off the stage here.
So I'll just make a pretty sweeping 30,000 foot comment on cyber risk in toto, and really this nexus between financial stability and cyber risk. I probably wasn't, I mean, these folks have worked in this space for a very long time, but just even with my own public policy lens, it wasn't really until the DDoS attacks in 2012 started happening that we had this.
The Iranians against the U.S. banks. Or some
Purported to be such against the U.S. banks.
That's what David Sanger said. Yes.
As reported by some news outlet. It's really come into focus, and it's come into focus at financial institutions. We talk about dollars and cents. Dollars and cents have been spent, and it's even gone to the extent where the regulatory community is trying to size up capital being held by banks against this risk. So I would say that the more work that we can do as a community to put more definition around this, to understand these maps, understand these vulnerabilities, where these costs actually lie, is incredibly helpful to the industry as a whole and its ecosystem, because Paul said, the interconnectedness, the interdependencies in this system are sweeping, and it can come from any point. And really getting this better, finer, sharper sense on what cyber risk really is, I think is just, it's the next 5-10 years of study away from market risk, credit risk, liquidity risks, cyber risk, really, and how this fits into operational risk as a toto is going to be critical.
And the scare scenario that I've been using is, what do we do when we're in a situation like 2008, and you get the Secretary of the Treasury and the New York Fed President, everyone together with the bank CEOs, and they're trying to hammer this out, and someone doxes the Secretary of the Treasury. They release their emails of what was happening and trying to do this communication, right? A simple attack, and yet imagine the consequences of, oh, look at the sweet deals that are happening here, and you just don't get a solution. You get resolution. Paul, any final comments? Okay. Siobhan or Chris?
Yeah, read the Financial Times, stay engaged in geopolitics, and come and work in financial services.
Great.
And I think the most exciting thing is the work that the private sector is doing collectively to think about how to recover from one of these massive cyber attacks. And I think that is interesting for two reasons. One, I think the collective IQ resources that can go into that is fantastic. And so, that makes me feel like we'll get this problem solved. And second, I think it really makes us all step back and ask, what is really crucial to happen in the financial sector? We have a lot of bells and whistles, special products, all kinds of things, but we're really talking about keeping the basic economy going and making this a little bit simpler problem that is focused on those critical services could really help us a lot.
And I want to point out, one of the, when you were talking about we've had these crises and we've had to learn from these crises, I know many of the people in the audience might have said, well, why do you have to wait for the crisis to learn? And it's something that we didn't talk about here, and it's incredibly impressed me, is how many exercises the sector has done. There's some called the Hamilton series that I don't think much has been published on. There's been the Quantum Dawn series, and there has been some publications on Quantum Dawn, that students could find and research in their papers. But Phil Venables and some of the other CISOs and other risk officers have really highlighted the incredible lessons that have come out from these exercises of going through and learning the pain at the most senior levels of the banks and the regulators, and learning that pain and then taking it away. The one last thing I'll say is we talked about public-private sector partnerships. Since truth and sharing, the financial services ISAC started in 1999, so they're coming up on their 20th anniversary of doing this active sharing. In 2002, the finance sector set up two groups, one called the FISIC, that was the sharing at a more senior level and talking about policy coordination amongst the senior executives within the finance sector, and the FIBIC, FBIIC, which was the senior regulators. And that was 2002, so 15 years. And what I loved about it is they would meet in the same location, and they would meet separately in the morning, and then they'd come together to meet together in the afternoon. So the regulators and Treasury, they're together with the senior private sector folks, and talk about trust, talk about building bridges, not building about walls, and so that's what I loved about this sector. So I told you it was going to be a fantastic panel, and they nailed it. All right, everyone. Thank you very much. I invite